Meet Daniel, 57 years old, 30 years in logistics management outside of Columbus, Ohio. $80,000 saved, feels completely prepared for retirement. Ray Dalio would look at Daniel's portfolio and say, he is one of the most exposed investors in America right now. This is the brutal truth of our current economic reality, a reality that punishes the responsible and rewards the proactive. And to understand why Daniel is in such a dangerous position, we have to look past the illusion of everyday financial advice and examine the underlying mechanics of the global economy. For 3 decades, Daniel did everything right according to the traditional playbook, living below his means, consistently putting a portion of his paycheck into a mix of savings accounts, mutual funds, and government bonds, believing that his discipline and approach would guarantee a safe, comfortable retirement. He is not careless, he is not reckless, and he is certainly not naive, but the harsh reality is that the rules of the game have fundamentally changed beneath his feet, and the strategies that worked from 1980 to 2020 are now the exact mechanisms that will destroy wealth in the coming decade. Ray Dalio, the legendary founder of Bridgewater Associates, has been warning us about this unambiguous shift, pointing to a historical framework he calls the long-term debt cycle, a macroeconomic phenomenon that occurs roughly every 75 to 100 years, when a society accumulates so much debt that the central banks are forced to devalue the currency to manage the burden. Think of the economy as a massive, complex mechanical clock where the gears of credit, debt, productivity, and inflation must all turn in perfect synchronization. But right now, the main spring of this mechanical clock is wound too tight, and the pressure is building to a breaking point. When Daniel looks at his portfolio, he sees safety. But when Dalio looks at that same portfolio, he sees a tragic vulnerability to 5 distinct investment traps that are set to spring before 2027. Traps that are insidious because they are disguised as conservative, prudent financial decisions. The first of these traps is what we call the safety trap, which is the heavy reliance on long-duration bonds. For generations, financial advisors have preached the gospel of the 60-40 portfolio, advising people like Daniel to shift heavily into long-duration government bonds as they approach retirement age to protect their capital from the volatility of the stock market. However, in the late stages of a long-term debt cycle, when inflation accelerates and interest rates are no longer reliably anchored near zero, long-duration bonds become incredibly dangerous instruments. When you buy a 10-year or 30-year bond, you are lending your money at a fixed interest rate. But if the central bank is forced to print more money to monetize the national debt, the purchasing power of the currency you will eventually be paid back in is dramatically reduced. Furthermore, as inflation forces interest rates higher, the market value of those existing low-yield bonds plummets, meaning Daniel is locked into an asset that not only fails to keep pace with the rising cost of living, but also loses principal value if he tries to sell it before maturity. It is a cruel paradox where the very instrument designed to provide stability becomes the source of severe portfolio erosion, acting as a slow, grinding mechanism that drains wealth without ever triggering the immediate fear and panic of a stock market crash. Daniel looks at his bond statements and sees steady, predictable numbers, completely unaware that the real inflation-adjusted value of his supposed safety net is evaporating day by day. This brings us to the second trap, which is perhaps the most universally misunderstood concept in personal finance: the invisible tax of excess cash. Daniel has always prided himself on keeping a robust cash reserve, viewing his savings account as a fortress against life's uncertainties. But in an era of rapid monetary debasement, cash is not a fortress. It is a melting ice cube. The purchasing power of fiat currency is constantly under attack by the systemic need to inflate away sovereign debt, making cash one of the worst long-term holdings imaginable. This is not a matter of temporary market fluctuations. It is a structural necessity of the macroeconomic machine. When governments accumulate deficits that can never realistically be paid back through taxation or productivity growth, their only recourse is to print more currency, thereby expanding the money supply and diluting the value of every existing dollar in circulation. This monetary debasement is the cruelest and most insidious form of taxation because it does not require a vote, it does not appear on a pay stub, and it disproportionately punishes the responsible savers like Daniel who have dutifully parked their life energy in bank accounts, yielding a fraction of the true inflation rate. The prices of food, housing, healthcare, and energy do not go up simply because things are getting more expensive to produce. They go up because the denominator, the dollar itself, is becoming worth less. If you are sitting on excessive amounts of cash right now, you are essentially guaranteeing a negative real return on your wealth, willingly offering up your purchasing power to be siphoned off by the system. I want you to pause for a moment and think about your own financial situation. Look at the allocation of your assets and ask yourself how much of your hard-earned money is currently sitting in cash or low-yielding savings accounts. Drop a percentage number in the comments right now. No judgment, just a moment of honest assessment, because recognizing the exposure is the first necessary step toward protecting yourself. Once Daniel begins to grasp the reality that his cash and bonds are betraying him, he naturally looks toward his equity investments for salvation, which leads him directly into the third trap, the fee vampire of actively managed funds. Over the course of his 30-year career, Daniel has blindly funneled his retirement contributions into target date mutual funds and actively managed portfolios recommended by his company's plan administrators, assuming that the well-compensated fund managers in Wall Street suits are utilizing superior intelligence to beat the market. What he fails to realize is that the vast majority of these actively managed funds consistently underperform their benchmark indices over a long time horizon, yet they relentlessly extract their management fees, expense ratios, and hidden administrative costs year after year, regardless of whether the fund makes money or loses money. In a highly inflationary environment where real returns are already squeezed, these fees act like a vampire, quietly draining the lifeblood of compounding growth from Daniel's portfolio. The math of compounding is a miraculous force when it works in your favor, but it is equally destructive when applied to expense ratios over a 20 or 30-year period. A seemingly negligible fee of 1 or 2% might not sound like much to Daniel today, but over the lifespan of his investments, it equates to hundreds of thousands of dollars in lost potential wealth, money that was siphoned out of his retirement and transferred to financial institutions that took zero personal risk. Ray Dalio's principles heavily emphasize the importance of understanding exactly what you are paying for. And in a macroeconomic landscape where every basis point of return is critical for survival, tolerating the fee vampire is a luxury that no investor can afford. You must ruthlessly audit your investment vehicles, stripping away the bloat of active management fees and transitioning toward low-cost, highly efficient index funds or direct asset ownership that allows you to capture the market's return without paying an exorbitant toll to the gatekeepers. As Daniel starts to audit his statements and recognize the bloodletting of these fees, he mentions that at least his home and his real estate investments are solid, completely missing the fourth trap, the rate illusion of debt-sensitive real estate. Real estate is traditionally championed as the ultimate hedge against inflation, and historically, this has been true. But the current environment is uniquely perilous because of the violent repricing of debt. For the past 15 years, the world has been intoxicated by zero interest rate policy, leading to a massive inflation of asset prices, particularly in commercial and residential real estate that relies heavily on leverage. Investors and property owners became accustomed to easily refinancing their mortgages at rock-bottom rates, creating an illusion of perpetual affordability and ever-increasing valuations. However, when the long-term debt cycle shifts and central banks are forced to hike rates aggressively to combat the very inflation they created, the math of real estate dramatically changes. Debt-sensitive real estate, properties that rely on constant refinancing, floating rate debt, or highly leveraged syndications, suddenly becomes a massive liability. The cost of servicing that debt skyrockets, crushing cash flow and forcing distressed sales, which in turn drives down property values across the board. If Daniel were to run a sensitivity analysis on the broader real estate market or even on his own local property values, he would see that the capitalization rates are completely disconnected from the new reality of the risk-free rate of return. Why would large institutional investors take on the headaches of property management and the risks of illiquidity for a 4% return when they can get 5% absolutely risk-free in short-term government paper? This dynamic forces a brutal repricing of real estate assets, and those who are caught holding highly leveraged, debt-sensitive properties will find their equity wiped out as the cost of capital accelerates faster than their ability to raise rents. It is a dangerous illusion to assume that all real estate is safe. Only unencumbered, high-quality properties with strong inflation-resistant cash flows will survive the transition, while the debt-heavy portfolios will collapse under the weight of their own leverage. Daniel is overwhelmed by this point, realizing that his bonds are sinking, his cash is melting, his mutual funds are bleeding him dry, and the real estate market is on the precipice of a massive debt repricing, but he still clings to one final comfort. He believes he is properly diversified. This brings us to the climax of his financial awakening, the realization of the fifth and most devastating trap, the dollar prison. Daniel proudly lists his assets, his 401k, his IRA, his savings account, his home, his domestic stock portfolio, and points to the pie charts showing a neat division among different asset classes, genuinely believing he has achieved the holy grail of diversification. But Dalio's framework reveals a terrifying flaw in Daniel's logic. Every single one of those assets is entirely denominated in United States dollars, and their performance is inextricably linked to the health of the American financial system. He doesn't actually have a diversified portfolio. He has a portfolio of different bets placed on the exact same underlying currency and the exact same macroeconomic policies. When you look at the correlations between domestic stocks, domestic bonds, and domestic real estate during a period of severe monetary debasement or a sovereign debt crisis, you see that they all move together in a downward spiral of real purchasing power. This is the illusion of diversification, a false sense of security that traps investors inside a burning building, convincing them they are safe simply because they are standing in different rooms. To truly escape the dollar prison, an investor must understand geopolitical shifts and the changing world order, recognizing that capital must be diversified not just across asset classes, but across currencies, jurisdictions, and fundamentally different economic systems. Ray Dalio frequently points to gold, commodities, and emerging markets as essential components of a genuinely diversified portfolio because these assets operate outside the direct control of the Federal Reserve's money printer. Gold, for instance, is not merely a shiny rock. It is a historical constant, a non-sovereign monetary asset that cannot be created out of thin air, and its value naturally adjusts upward to reflect the debasement of fiat currencies. Commodities like energy, agriculture, and industrial metals are the tangible building blocks of human civilization, and their prices are dictated by physical supply and demand rather than the whims of central bankers. By failing to allocate capital outside of the dollar ecosystem, Daniel is entirely exposed to the specific systemic risks of a single empire in the late stages of its debt cycle, a vulnerability that no amount of domestic asset shuffling can fix. The realization hits Daniel like a physical blow, a profound cognitive dissonance as he understands that the very actions he took to be responsible have placed him in the crosshairs of a systemic wealth transfer. He is not foolish. His ignorance was manufactured by an industry that profits from keeping retail investors blind to the larger macroeconomic currents. But now that the invisible forces have been made visible, The fear of the unknown transforms into a burning desire to protect his legacy. We have seen this exact scenario play out throughout human history, from the gradual clipping of silver coins in the late Roman Empire to the wheelbarrows of worthless paper cash in Weimar Germany during the 1920s. The mechanics of debt and debasement are always the same, and the outcome is always a devastating wealth transfer from the uninformed public to the prepared minority. The citizens of Rome and the citizens of the Weimar Republic who trusted their governments to protect their purchasing power were left destitute, while those who recognized the shifting tides and repositioned their wealth into hard assets, productive businesses, and alternative currencies managed not only to survive, but to build generational fortunes. We are standing at a similar historical precipice today, and the window of opportunity to reorganize your portfolio before the traps completely spring shut is closing rapidly. You cannot rely on hope, and you cannot rely on the outdated advice of traditional financial planners who are structurally incentivized to keep your money trapped within their fee-generating systems. You must take radical ownership of your financial intelligence, applying the macroeconomic frameworks of thinkers like Ray Dalio to see the economy not as a series of random events, but as a predictable machine with clear cause and effect relationships. You must eliminate the long-duration bonds that lock you into negative real yields. You must deploy your excess cash into assets that cannot be inflated away. You must eradicate the fee vampires draining your compounding growth. You must avoid the debt-heavy real estate sectors facing severe repricing, and above all, you must break free from the dollar prison by achieving true global cross-currency diversification. This is not a time for panic. Panic is the reaction of the unprepared. This is a time for calculated, deliberate action, a time to transition from being a passive victim of the macroeconomic machine to an active architect of your own financial fortress. So I ask you to look honestly at your own investments, consider the 5 traps we have just dismantled, and ask yourself the hard questions about your true exposure to the coming economic storm. Tell us which of these 5 traps you are reconsidering and what you are planning to do differently to protect your wealth and your family's future. Drop your thoughts in the comments below. Engage with this community of forward-thinking individuals. And let's navigate this shifting world order together.